Welcome to Iron Financial. Today, we're putting a market titan under the microscope. In this explainer, we'll stress test Texas Roadhouse to see if its foundation is still solid steel or if it's starting to show dangerous cracks.
Texas Roadhouse. For years, this has been a fortress of a stock, a real heavyweight champion in the casual dining space. You look at the chart, you look at the growth, and it just screams stability. But their latest earnings report? Man, it showed some serious cracks. So the question is, are these superficial, just some paint chipping off the walls? Or is the foundation itself actually starting to crumble? Because the way the market sold it off, you think the building was condemned. And that's the exact question we're here to answer. We're not just reading a report today. Think of us as the inspection crew. We are going to analyze the original blueprints, we're going to stress test the load-bearing financials, and we will run the numbers to find every single weak point. By the end of this, you'll have our verdict. Is this dip an opportunity for investors with some steel resolve, or is it a value trap that's about to collapse? Let's get to work.
Okay, first things first. You absolutely have to respect the structure they've built. You just can't analyze the cracks without first understanding the integrity of the original construction. This is not some fly-by-night operation that was thrown together with cheap materials. We're talking about a meticulously constructed empire, built brick by brick over 30 years. So let's examine the blueprint. This growth trajectory you see here is a textbook example of compounding strength. It all started back in 1993 with an idea literally sketched on a cocktail napkin. By 1999, the foundation was laid with 67 locations. Then came the pivotal moment in 2004, going public. That's when they brought in the serious capital to pour the concrete for the skyscraper they were about to build. Fast forward to early 2025, and they reached the absolute pinnacle, unseating Olive Garden to become the undisputed king of casual dining. Now, that isn't luck. That's a rock-solid operational plan executed with relentless, brutal precision.
And the numbers, well, they back this up with overwhelming force. This table right here represents the financial bedrock of the entire company. Just look at this revenue progression. In 2001, they were at a respectable $160 million. Okay, not bad. By 2007, they've nearly quintupled that to $740 million. That's a compound annual growth rate that would make most tech startups blush. Now look again at 2014. They've more than doubled again to over $1.5 billion. By 2019, right before all the pandemic chaos, they've nearly doubled again to $2.76 billion. And by 2024, they've almost doubled yet again to over $5.3 billion. This isn't just growth. This is exponential reinforcement. This is not just a popular restaurant. It's a financial juggernaut that has compounded shareholder value for an entire generation. Okay, that history is impressive. The building is strong, I'll grant you that. The blueprints are solid, and the growth is, well, it's undeniable. But even the strongest skyscrapers face earthquakes, right? So has this foundation ever been truly stress-tested before? Really, shaken to its core. Because what we just saw in Q4, that felt like a real tremor.
Oh, it has. And that's the crucial point. Early on, they hit a potential catastrophe that could have leveled the entire enterprise before it even really got started. So let's turn back the clock to 1994. This wasn't just a test. This was a near-death experience that literally forged the company's character.
So you're telling me 3 out of their first 5 stores failed? That sounds less like a crack and more like a sinkhole opening up right under the lobby. Most startup companies would never, ever survive that. That is a catastrophic failure rate. It suggests the initial blueprint wasn't just flawed, it was fundamentally broken. Exactly. A lesser team would have folded up shop, no question. But this is the moment that truly defines the entire company culture. They didn't just patch the holes, they re-engineered the entire model from the ground up. They diagnosed the core flaws, bad locations, inconsistent food, poor execution, and they brought in a new architect, a director of food and beverages who systematically overhauled every single thing. And this wasn't just about changing a few recipes. No, this was a complete rebuild of their operational DNA. They implemented rigorous, data-driven site selection criteria. They standardized food prep to guarantee a steak in Ohio tasted exactly like a steak in Florida. They invested heavily, and I mean heavily, in training their roadies to create a consistent, high-energy atmosphere. The menu, the supply chain, the training, the decor, all of it was reforged in the fire of that failure. This wasn't a repair job. It was a complete structural upgrade. This moment proved that when faced with an existential threat, this management team doesn't panic. They analyze, they rebuild, and they come back stronger. That muscle memory from 1994 is the bedrock of their success today, and frankly, it's what bulls are betting on to get them through this current crisis. All right, so they've proven they can rebuild, I'll give them that. But come on, that was decades ago, with a handful of stores. Let's talk about the here and now. We're dealing with an empire of over 800 restaurants. The Q4 2025 numbers are what's shaking the market today, and they look ugly. There's no nostalgia in these figures. There is absolutely no sugarcoating it. The numbers were a shock to the system, and the market reacted exactly as you'd expect. So we're going to hit them one by one, number by number, and analyze the damage. The pressure is on. First up, net income, the bottom line. It plunged nearly 27% year over year. Let's be perfectly clear about this. Profits aren't just down, they have completely fallen off a cliff. This is the headline number that sent shockwaves through the entire investment community. Wow, that is a huge number. That's not a small leak, the main waterline just burst. For a mature, stable company of this size, a 27% drop in profit is a 5-alarm fire. So where is that bleeding coming from? You don't lose over a quarter of your profit by accident.
And it's coming from this, a massive earnings miss. Wall Street analysts, the people whose entire job is to model this company's performance, they expected an earnings per share of $1.52. Texas Roadhouse delivered only $1.28. That is a 24-cent miss per share. What's crucial here isn't just the number, it's the psychology. This kind of miss completely shatters confidence. It tells the market that either management doesn't have a good handle on its own business or that the headwinds are far, far stronger than anyone anticipated. It forces every analyst to question their models, and that uncertainty is exactly what spooks investors and causes a sell-off.
And this number, 309, this brilliantly illustrates the root cause. Restaurant margin, that's the core profitability of each and every location. It dropped by 309 basis points, 3.09%. In the restaurant business, margin is absolutely everything. This is the most critical stress point in the entire report. 309 basis points, okay, break that down for us. So for every dollar in sales that comes in the door, they're keeping a lot less of it as profit. Why? What's eating into that margin? I mean, this is the engine room of the company, and it sounds like it's flooding. 2 words, inflationary pressure. The cost of their raw materials is just exploding. Commodity costs, we're talking beef, potatoes, everything they serve, spiked 9.5% in the quarter. And at the exact same time, labor costs were up 2.9%. To put it in our terms, the cost of the steel and concrete for their structure just went through the roof, and it's eating their profits alive.
And this chart visualizes it perfectly. A gut-wrenching drop from 17% all the way down to 13.9%. That is a structural weakness you can see plain as day. And get this, even with their total sales going up 3.1%, their actual profitability is getting crushed. It's like running faster just to fall further behind. This is the absolute definition of a high-pressure situation. And right now, it looks like the walls are closing in. So, the structure is under immense stress. That's been established. The critical question now is, what is management doing to reinforce it? Are they bringing in fresh concrete and rebar, or are they just slapping on a fresh coat of paint and hoping nobody notices the cracks? Let's analyze their blueprint for the counterattack. Well, it looks like management has a clear 3-part plan. First, they're playing offense with aggressive expansion. They just dropped $72 million to buy 5 franchise locations, which brings that revenue directly in-house. And this is on top of 20 other acquisitions and 28 new builds just last year. Second, they are directly addressing the margin pressure by passing a small 1.9% price increase to customers. And third, they're signaling confidence by raising the dividend. That's a direct message to shareholders that says, we are stable, we are profitable, and we will continue to reward you for sticking with us through this. That all sounds fine on a press release, sure, but let's pressure test this plan. Is it enough heavy lifting? Aggressive expansion is great, but buying more stores doesn't fix the margin compression in the 800 stores they already own. And a 1.9% price hike? Seriously? When their input costs are soaring by high single digits? That feels like trying to patch a dam with chewing gum. It just seems dangerously insufficient. And they're basically telling us right here, the storm isn't over. Not by a long shot. They're projecting another 7% jump in food costs and 3 to 4% in labor for 2026. So the inflationary hurricane is still a Category 5. How in the world can that tiny 1.9% price increase possibly be enough to shore up the defenses against that kind of onslaught? The math just doesn't seem to work for me. That right there is the billion-dollar question. And on the surface, you're absolutely right. It looks like a losing battle. But don't overlook that last bullet point. It is the single most important number on this entire slide. Comparable sales, that's the sales at existing stores, are accelerating hard into 2026. They're up a massive 8.2% so far this quarter. What that means is that customer traffic is the ultimate foundation. As long as people are flooding into their restaurants, they have leverage, they have volume. And that traffic is a powerful, powerful counterforce to the margin pressure. Okay, we've stress-tested the structure. We've examined the historical blueprints from way back in 1994.
we've inspected the current cracks from the Q4 report, and we've analyzed management's plans for reinforcement. It is time for a verdict.
The bear case is simple and it's powerful. The fortress is being besieged by inflation, and the walls, the profit margins, are shrinking fast. The math on that 309 basis point drop is undeniable, and frankly, it is scary. If they can't get costs under control, this could be the start of a long-term systemic decline in profitability. This quarter might not be an anomaly. For all we know, it could be the new normal. But the bull case is that this building was designed for exactly this kind of weather. We have seen this before. This company has a foundation of steel forged in the fire of that near-fatal failure back in 1994. They are built to withstand this kind of pressure. That explosive 8.2% sales growth is the ultimate proof of their brand strength. The market is panicking and overreacting to one bad quarter that was heavily impacted by macroeconomic headwinds, not a fundamental flaw in the company itself.
And the CEO's statement right here tells you everything you need to know about their mindset. They acknowledge the pressure, they aren't hiding from the bad numbers, but their focus remains on the long-term operational blueprint, preserving value and operational excellence. They aren't panicking. They're not going to slash quality or gut the customer experience just to save a few points of margin in one quarter. No, they're doubling down on the very things that made them number one in the first place.
So, our verdict is in. The recent damage is real, and the quarterly report was ugly. But it's not structural. The foundation of this company, its brand loyalty, its operational model, and its incredible customer traffic remains solid as a rock. The inflationary pressures are a severe storm, yes, but they are not a terminal flaw in the building's design. So you're saying the cracks are just cosmetic? That the market is wrong to be this scared? I mean, that's a bold call after a 27% drop in profit. I'm saying the market is pricing this stock for demolition when all it needs are expert repairs. The long-term load-bearing capacity of this business is fully intact. For investors with a solid time horizon, for those who can withstand the current turbulence, this stress test has revealed not a value trap, but a compelling buying opportunity and a best-in-class operator. That's the Iron Financial verdict. Forge wisely.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.